Hi, everyone. Cathy Sabater, mortgage broker and proud veteran. I'm here with Jesse Lipscomb. He's with Roadmap Tax Services, and he's an enrolled agent. Hey, Jesse.
Hey, what's going on, Kev?
Nothing much, but I want to thank you for joining me because what we're talking about today is that one big, beautiful bill, 2025 tax reform, and how it really affects us as individuals, consumers, homeowners, and etc. So
Yeah, yeah,
I know you mentioned that there's a couple of home runs that are in here. And again, because we're such self-serving individuals, hear more about what we are affected with. So can you briefly
hmm
tell us, from 2025 tax reform, how it's really helping us as consumers?
yeah, absolutely. The, people are really not going to feel the benefit of that they're receiving, but it's tremendous. 2017, 2018 tax reform, the Tax Cuts and Jobs Act, all of those lower tax brackets were about to expire at the end of the year, which meant that all of us were going to pay more taxes in 2026. Now that the fact that the lower rates are permanent, that means that Congress can still pass a law to raise your taxes, but now it has to be proactive from Washington, as opposed to just sunsetting and automatically raising. So from a planning standpoint and a cash flow standpoint, I really like these lower tax brackets. Additionally, for our real estate investors and business owners, getting back 100% bonus depreciation is wonderful. And for homeowners, being able to write off more of your state and local taxes, I think that's pretty awesome as well. Speaking of permanency, I mean, it's not just the brackets, it's the higher standard deduction and child tax credits. Being able to write off 20% or up to 20% of your business profits, the qualified business income deduction, taking money out of your 529 accounts, being able to have the higher estate tax and gift tax exemption, that's nice. Again, bonus depreciation, and now you can do direct charity. But if you're somebody that's renting and you want to buy a house, being able to deduct up to $40,000 in state and local taxes is pretty nice. The reason there's an asterisk there is that that's for people making up to $500,000 single or joint. If you make over $500,000 a year, then it gets back down to 10 grand. But for a lot of people out there buying a house, you're making 100 grand, 200 grand, 300 grand a year. Being able to itemize and write off both your property taxes and your state income taxes, it's pretty nice.
That's interesting. What's so interesting about that is that a lot of people didn't understand the limits that we had. When it first came out that property taxes were going to be limited to $10,000 a year, people are doing their
hmm
taxes. Some of us understood it and some of us didn't. But a lot of it has to do with when you purchase your home, right? The property
hmm
taxes that you have, because I know you mentioned, I think it's 750,000 now. It's the purchase price that it maxes you
Yeah.
out in regards
So
to your property. Can you briefly talk to us about that?
sure. So $750,000 is the acquisition indebtedness limit. Think of it this way: VA, right? For all veterans here, you can acquire a $750,000 property with zero down. Okay, let's say you've got a service-connected disability. There's no funding fee, 100% VA loan, 750. All of the interest that you pay on that over the course of the year would be tax deductible. Now, let's say that you bought a $1.5 million property and you had $1 million loan. That situation, that $1 million loan, only 75% of the mortgage interest is tax deductible. Okay, it gets and the greater the property value, the greater the loan, the little bit more frustrating it is. But as an easy example, I've put together, what if you bought a $750,000 home as opposed to renting? Okay, in California, on average, it's about 1.25% for property taxes, 6.5% on a 30-year fixed. Hopefully, that's a good interest rate right now. And over the course of a year, there'd be about 48 grand of interest. So let's take a look at a single renter. $200,000 of income, standard deduction 14 grand, taxable income's 185. IRS taxes, California taxes, you're paying about $52,000 a year, as opposed to being able to itemize and write off your property taxes and your California income taxes and your mortgage interest. Now you can see that your taxable income is what, $50,000 less, which cuts your taxes down by almost $20,000. So if you think about renting versus owning, if you could own a property, have that pride of ownership and long-term opportunity to have the asset go up and build equity and save $20,000 a year, sounds like a pretty good deal.
Absolutely. Okay? Absolutely.
Right.
So thank you for sharing that with us. So we have a couple of slides that we have here, but we're really trying to focus on the home runs that are there for you, because as you know, again, the more tax you save, hopefully the more cash flow you can have. So Jesse's saying here, you potentially have $20,000 more in cash flow. And then we do know that, yes, if you're renting versus owning, your payment's going to go higher, but which would you prefer to have as far as benefit and making sure that your cash flow is going the way it needs to go, right?
You know, you're right. And in fact, if we go back in time and we look at 2017, 2018 tax reform, there were people, like groups of people, that tax reform helped more and some hurt more. And if you think about it, if you were married, had children, were a business owner, and you were a real estate investor, all four of those things, 2018 tax reform really helped you pay less money in taxes. The opposite, if you were single, no kids, W-2 employee, no business, and a renter, you ultimately paid more in taxes. So this example that we have here for the single folks out there, because the standard deduction is relatively low compared to what you'll get in state and local taxes and mortgage interest write-offs, this is actually a pretty huge benefit right now to acquire a property. Like I said, build equity and get that tax deduction in your primary. The same exact math, married, the savings are still good, but they're not as impactful, simply because the married standard deduction is much higher. Okay. But again, less is less, right? $1,000 less a year in taxes by building equity in your home. Cathy, one of the things that we had talked about a minute ago was the bonus depreciation is back. And it's interesting. This is effective January 20th of 2025, not January 1st. But if you're a real estate investor and you're going to acquire a rental property, you have a really great opportunity to benefit because of depreciation, specifically bonus depreciation. And when we look at, business owners can write off vehicles and equipment, but real estate investors can write off the improvements of real estate, not the land. Okay, kind of an easy example: you buy a $1.5 million house, rent it out. The land, we're going to say, is $500,000. Can't depreciate that, but the $1 million of additions or improvements, divide that by 27.5 years, you get to write off 36 grand a year. Just right off that means the first $3,000 a month as a landlord, the first $3,000 a month, completely tax-free to you. Then add in insurance and interest and property taxes. Conceivably, you can rent this property out for $5,000 or $6,000 a month and not even pay taxes on it. Okay, if a taxpayer can qualify as what's considered a real estate professional, meaning that they spend at least 750 hours a year in the real estate trades, and at least 51% of their time and income is from real estate. Now they can do what's called a cost segregation and take advantage of the accelerated or bonus depreciation. All a cost segregation is an engineering study to look at the improvements of the property, figure out which are structural and which are non-structural improvements. And what's a non-structural improvement? A sidewalk, a fence, right? Even a remodel of a bedroom or a bathroom. And what you have here now is the opportunity to take the $1 million of improvements over 27 and a half years, and maybe only $700,000 now is over 27 and a half, and 300,000 is immediate. So now you've got, as a real estate professional, you've got $325,000 of first year depreciation. If you're a real estate agent making 300 grand a year, federally, you just wiped out all your taxes. You're a plumber, you're a carpenter, right? You're in the real estate trades. If you can justify as a real estate professional, man, 100% bonus depreciation, you're talking about home runs. I think 100% bonus depreciation is a home run. I think the permanency of the tax brackets is a home run. And the depreciation is something we can all take advantage of if we are real estate professionals.
And I think when you mention tax brackets, I think a lot of consumers think that it's not including us. They think that only the rich are getting tax cuts. But with you breaking it down like this, I think people should now understand that if they lower the tax brackets, we're paying less tax. And so also remember that people who make a lot of money pay a lot of tax as well. Some people pay as much tax as I earn in a year. So when you're dealing with this, as far as taxes are concerned and its permanency, it has to do with us being self-serving individuals. And now that it is permanent, know that you should be able to save more money on taxes. But you do need a person like Jesse to kind of walk you through some of these processes so that you can maximize what is good for you as an individual. Real quick, Jesse, what's your phone number? If they need to contact you?
Yep, 619-280-2700. Full disclosure, it's better to go to roadmaptax.com and connect with us online. I'm usually back-to-back meeting-wise, but happy to help.
Great. And so we have so much more information to give you, but we wanted to make it as simple and simplistic for people like me to really understand in regards to the big, beautiful bill. And to know that I'm going to let Jesse just do the recap, and then hopefully you'll get in contact with him. There'll be a link to his website, so you can press that and connect with him directly.
Right. So again, a recap of this: the bill itself, we've got permanency now from the Tax Cuts and Jobs Act. That means, for example, if you're in the 12% tax bracket, it's not going to the 15%. If you're in the 22, it's not going back to 25. You're staying in the lower brackets that you've been accustomed to, which is wonderful. If you're a real estate investor or a business owner, we've got 100% bonus depreciation back to either acquire more real estate or build out your business. That's wonderful. That stimulates the economy. If you're currently renting or you own and are trying to buy a new permanent or new primary residence, being able to deduct up to $40,000 a year, itemized state and local taxes, that's pretty awesome. And again, renting versus owning, the opportunity to build equity in your own home, to take advantage of the opportunity to pay less money in income taxes by literally taking advantage of mortgage interest write-offs and state and local tax write-offs right on your own return. I think that's pretty powerful.
Well, again, Jesse, thank you so much for your time. And there'll be a link again for his website. You guys have a wonderful time. And I hope you enjoyed this video, and I will chat with you soon. Thank you, Jesse.
Thanks, Cathy.